Is the economy about to tank? Now, you might think, tank? How could it go sour when we today had such good news? For the first time in 44 years, Australia, in the last quarter, sold more things overseas than it bought. The first current account deficit of surplus. Sorry, I get so used to it after 44 years. The first current account surplus since 1975. Where's the cheering? In fact, our dollar then fell to under 67 cents US. That's nearly the lowest for a decade. In fact, every expert seems to think the economy is set for a big drop. And sure enough, retail sales figures today showed a fall last month. Shoppers are closing their wallets. And the Prime Minister's already warning that tomorrow's national growth figures could be terrible. But don't panic.
I suspect the June quarter results will be soft. But what matters is the plan that is already in place to address that.
All of the key economic indicators at the moment are negative for the government, and the government's very complacent about it.
I was joined a short while ago by Adam Creighton, economics editor of the Australian newspaper. Creighton, thank you so much for your time. So we've got our first trade surplus in 44 years, hallelujah, yet the dollar drops and the politicians aren't cheering. Why is that?
Indeed, certainly. You actually would have expected the dollar to increase, but it did fall. It actually fell. It's currently trading at around its 10-year low level. And I think the reason is because investors look straight through that current account surplus. They don't see it as a intrinsic sign of economic strength in Australia. They really just see it as an example of good fortune because China is continuing to buy our iron ore and coal. The prices of those commodities are at record high. And of course, there's been a series of disruptions in Brazil, which is also a big iron ore exporter, which has helped our current account as well. So that, I think, is why the dollar fell. And we also got some other news that retail sales went backwards in July. And I think investors focused on that because that's a much more recent statistic. The current account, of course, is only for the June quarter, which is a few months ago now.
Yes, and of course what China gives, China can take away, and it's slowing fast too. But talking about that retail figure today, a fall of 0.1% doesn't sound like much of a fall, but how serious is that?
Well, look, it's not super serious, although it must be said that in most months retail sales do expand. The current annual rate of expansion is about 2.4%, so that's not great, but it was lower in 2017, so I don't think that's any reason to be too concerned. I think the reason why these figures, these monthly figures, saw a bit more attention today was because, of course, the government introduced tax cuts in July. Now, the bulk of those tax cuts will be hitting people's wallets more in August, but nevertheless, some of it would have arrived in July, and so it was a bit unexpected that we saw retail sales go backwards. The expectation was for an increase of 0.2%, but it went back by 0.1%. So I imagine you'll be seeing the government tomorrow say that we should look ahead to the August retail sales figures for some growth. But of course, if we don't see it then there'll be some embarrassment for the government. It's worth pointing out, I think, that most evidence suggests that about half of tax refunds are actually saved. And so, personally, I would be a little bit pessimistic that we'll see a big boom in retail spending.
I want to get back to your point about the tax cuts so far not being reflected in those retail figures. But first, tomorrow's growth figures. Now, obviously, they're going to be the make or break number in terms of the economic news for the week. What are they likely to show? Why is the government moping around saying, well, you know, don't panic, don't panic?
Well, look, the growth rate for the year to March was 1.8%, and the expectation is for 1.5% for the year to June. Now, that is significantly below trend and certainly a lot below the forecast that the government put in the budget back in April. That was for 2.25%. And the Reserve Bank has about 2% for the year. So both of the official forecasts, the growth rate is looking to be significantly below those, which I think is pretty embarrassing, actually, for our forecasters to get it so wrong. Of course, this has implications for not only the credibility of the government's economic message, but also the surplus, of course, which is penciled in for this year, and also economic confidence. If growth is only 1.5% and population growth is about 1.5%, then that basically means we're standing still as a nation per capita.
Now, to get back to your point about the tax cuts claimed so far not feeding into the retail figures, one of the reasons the Prime Minister has given, and the Treasurer too, for listen, don't panic about bad growth figures for the last quarter. We've got the tax cuts coming through, the settings are right, and we expect the economy to kick back into shape with the next lot of figures in 3 months' time. The point is, they're putting a lot of hope on the tax cuts to help,
Yeah, they are.
when what tax cuts have come through don't seem to be doing the job.
Well, that's right. Look, the tax cuts, they really aren't that large. The government talks about these huge figures, $144 billion, but that's over 10 years. If you divide it by 10, that's only about $14 billion a year, obviously. And the economy is a $2 trillion economy every year. So these are very small amounts. And if, like I suggested before, half of households just save them, then you're not going to see much of an impact. It's worth pointing out that household debt is something like $1.8 trillion outstanding. And so, I mean, I would argue that a lot of people that receive these refunds will just save them. And in fact, that's what we saw in 2009 when the Rudd government sent out those $900 cheques, is that the vast bulk of it, or at least half of it roughly, was saved.
Well, that goes to a puzzlement I have, Adam. I'm a bit puzzled by the government's response. Now, like I say, the Prime Minister and Treasurer is saying, don't worry, whatever tomorrow's figures are, the economy will recover. But I just... it sounds to me quite complacent, and I'm just wondering whether the government shouldn't in fact be saying, look, things are tricky, the surplus is at risk, and that's exactly why now is the time for reform. Workplace reform, for instance, cutting green tape, maybe cutting payroll tax, anything, rather than sitting there like a sitting duck saying, things, the Micawber things will improve, something will turn up.
Yeah. Well, look, I think the government is just so wrapped around its message of a surplus that it really doesn't want to have to relax anything that could see that not occur. And so I think that is why the government is being optimistic. I mean, the big unknown really for the government, for all of us, is whether these ultra-low interest rates will prompt another bout of borrowing and economic growth, or whether that lever, if you like, has been pulled too many times and it's not going to work this time. We have seen, of course, some pretty rapid increases in house prices this month, by I think about 1.6% in a single month in Sydney. So it remains to be seen whether that continues, and also it remains to be seen whether that's a healthy thing at all. That lever can't be pulled all the time to increase house prices to boost confidence. And of course, for those people that don't own a house, it's certainly not a boost in confidence for them. So I think we just need a few more months to see whether that same effect is going to occur in the housing market.
And just lastly, another thing that surprises me a bit, why are share prices so high when optimism about the economy is so low?
Well, look, that's basically because there's an almost mechanical relationship between the official rate of interest rates and the value of the share market, the value of houses. The lower interest rates are, the higher asset prices are, and that's not just true in Australia, that's true all around the world. You've got record share prices in the US as well, of course, and in some countries in Europe. And so when it's cheaper to borrow, that naturally lifts the price of assets. And that's not because of anything kind of intrinsically great about the assets themselves, it's just because it's cheaper to buy them.
Adam Creighton, thank you so much indeed for your time. We await tomorrow's economic growth figures with some trepidation. Thank you so much.
Indeed. Thanks, Andrew.